Before we start, Andy, I'd just like to say a quick thank you to our podcast sponsor, Fidelity International. Now, Fidelity is one of the best known investment platforms and global fund managers out there and is responsible for around £320 billion from over 2 million clients globally. Now, I currently use Fidelity's investment platform to run my own 80/20 investor portfolio, and they give access to ETFs, investment trusts, shares, and even unit trusts. For investors looking for ideas where to invest, then Fidelity also offer guidance, fund shortlists, alongside fund suggestions from their investment director, Tom Stevenson, who also happens to be a columnist for The Telegraph. Now, don't forget that you also have the option of putting your money in cash now, so you can secure your ISA allowance and make your investments later once you've made up your mind. Now, if you want to find out more information, you can do so at fidelity.co.uk. Now on with the show.
Hello and welcome to episode 217 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leach. Damien, welcome back.
Oh, good to be back, eh?
That was different, wasn't it?
It was a slightly different intro, slightly softer, which threw me. No, it's good to be back. I'm absolutely buzzing this week. I really am. We had such a good... we had a busy week, but we've had such a good week because we have been doing content. We've been out and about, haven't we? And I did a panel discussion on, what day was it? Wednesday?
It was Wednesday the 3rd of April, yeah.
And I did a panel discussion, the one that we've been talking about over the previous weeks, which was an event sponsored by Habito. And it was all about the future of property, but there are lots of topics we did cover in that panel discussion. And it's actually going to form one of the pieces for today's podcast, because there was so much stuff that we covered and I spoke about, and so did the other panelists, that it had it's got a lot of value. So I think listeners would like to hear that. Those of you who didn't come, of course. So thank you to those who did, which we'll come on to at some point with the legend that is Neil.
Yeah.
We'll give Neil a quick name drop. So yeah, I'm good. How about you?
Yeah, I'm really good. I mean, we've been really busy in the office, and normally we catch up on what we've been going out, but we're going to probably hijack this podcast and talk about what we've been doing this week, really, in this podcast, in that very bit you said about Habito. But we're going to do that in a second. What else have we got coming up? Because there'll be a couple of other bits we're covering, I'm assuming.
Yeah, so we've got the Habito piece. We've also got a piece on, it was just a question I was asked regarding transactions on investing. So if you're wanting to take profits on an ISA, for example, or some investments. So it was a question just around the actual logistics of it. So I'm going to quickly touch upon that as a small piece at the end. But the other piece we're going to do is going to be driven by Andy, and that is on
Drain Delay Refunds. That's what it is. And it's called Delay Repay, and it's a national scheme. And I don't think enough people know about it. And actually, we've been talking about it in the office, and we've actually used it ourselves. So I thought it might be good to cover that.
Yeah, and there's some nuances of this, because Andy and Lauren in particular travel by train to the office, and Lauren is a real stickler for getting her refunds and value for money, and she'd been getting the refunds on that because obviously our train services are dire in this country, so it was partly inspired by that and Lauren's conscientious nature, and so it's been passed on to Andy as well, so Andy's going to lead the charge.
Good. So what are we going to start with this week?
Let's start with the Habito event. Now, I have to laugh because Habito is a name which often I would call Habito.
Well, we've been calling it Habito for the last 2 weeks, and every bit of video, and everything we've done, audio.
I even did it during the panel discussion, which was makes me a bit of a legend in my book.
You did cause a few looks, and
you rock up, do an event, and you just mispronounce the name of the people who were hosting it.
That's okay though, because they introduced you as Damien Fahy.
Yeah,
so.
Perhaps it was a deliberate. Yeah, damn right. Yeah. So yeah, on that note, I actually had a couple of you email me because I mispronounced something else the other week. We were talking about credit reports. So
that's right.
It was, I said noodle.co.uk. It's noddle. It's double D, not double O.
But on the plus side, the Asian market has been influxed because people have been buying noodles. So, I mean, we'll be covering that on the stocks podcast on Wednesday.
So it's lucky that Andy links to all the things we talk about in the podcast, because you can go and actually check out what the correct thing was. Because on that, there's a couple of other bits. Somebody pointed out last week, I think it was the other week, I did a piece on the tax year checklist, and I mentioned about the £3,000 allowance you get to be able to pass money on to other people, and I said it didn't carry over, but it does. It carries over for 1 year, And if you'd gone through to the article that I'd written on the subject, you would see that it does. And I obviously said it incorrectly on the podcast, for which I apologise. So somebody, I think the name was Laura who wrote in, but I love this fact that people write in. They're listening, we're educating them, but more importantly, that we do link them to articles just to double check what we're talking about for more information.
We obviously try and be as accurate as possible on the podcast, but when you're sort of, you're flying from one thing to another, I have to be honest, you write notes and you fly from one thing to another. The articles and the website are our sort of bread and butter, aren't they?
Well, no, you go and check out the details. That's where we put everything down. And after 217 episodes, it just proves I'm human. And one other one, actually, that was pointed out to me recently, we did a very general piece on stocks and shares ISAs and the best platforms. And Interactive Investor is obviously a very good platform, very cheap, and one of the best for holding Vanguard funds. But there is even cheaper one. If you go to our best stocks and shares ISA article, which if you just Google that phrase, you'll find it on Google, or if you go on our website, and on those tables, you will see the prices we put out. And iWeb are pretty good as well. So I just want to point that one out. They're not as haven't got all singing and dancing as Interactive Investor in some ways in terms of the content they produce or anything like that. But if you just want something that is just simple, cheap, then they don't charge an annual fee for their platforms. They do charge you up front £25 to actually open an account, but they do charge you £5 every trade. So if you keep trading, they soon rack up and they end up becoming more expensive. But if you don't and you just buy and hold, then they're another pretty good one. But all this stuff, like I say, is on our website. So go and check out for all the finer details.
Yeah, let's not make this a weekly feature on our podcast, the corrections.
No, we won't do it. I just like the idea. It just shows I'm human. And just like the FT have to publish corrections, we're not immune to that either. So anyway, Habito. Let's done it again.
Habito. What have we got?
That company that does mortgages.
Yeah. So you went along on Wednesday and you were part of the panel, and there were people there. There was people from Moneybox. There was a guy from Nested who set up Nested, and also the CMO of Habito as well. And it was all run by journalists at City AM, and it was a really interesting event for someone. Actually, I imagine it was probably interesting for people who weren't even involved with house buying, because there was some really interesting stuff there.
Andy didn't actually mention it. He went. So all the guys from Money to the Masses did go. So although we promised they would, they did. There was about 200 odd people actually came to the event, and the age range was quite mixed. There were a number of young, I would say, I don't like the terms millennials or anything like that, but that sort of age bracket all the way up to sort of our age, Andy, guys tipping into their 40s and a few older ones as well. So it was a good event. It was well attended. And the range of questions, we didn't get a lot of questions that we were able to answer directly from the audience, partly because one chap stood up and gave a speech, it seemed, that went on forever.
He was really good. And after about 5 minutes, he got asked, have you got a question? After educating the audience for 5 minutes. I thought he was on the panel at one point.
No, but I just want to pick up on some key pieces about that were mentioned on that, about property. So property prices was a question that was brought up about where do people think property prices are going in the next year or so, or in the future. Now, you could get a coin and toss it, and that's whether they go up or down or stay the same. Generally speaking, I don't have a clue where house prices are going, but if any of the recent movements are anything to go by, we could be on average where we are now. Brexit seems to be the thing that everybody's hanging their hat on, but Brexit keeps being kicked down the road. And also, speaking to the people I know in the market, in the estate agency market, they're not seeing Brexit being as big a deal for people who are moving houses as people anticipate. And part of that is probably because a lot of the people moving are moving because they need to. So necessity takes over. And you've got to think that what's going on in Westminster is dragging on and on and on. If you're going to need to move house because of schools for your children or anything like that, that's going to happen. The thing to mention from my point of view and the people who I know tell me, the market is very split. There's lots of markets all over the place. So what goes on in London is very unique to London, what's compared to what goes on in the rest of the country. So house prices in other places are going up, while in some places they're going down. Now, people say whether it's a buyer's or seller's market, and again, that is split. So if you go for high-end property, so things that are like £1 million plus, then that is definitely becoming a buyer's market, because people are struggling to sell those houses, because partly foreign investment that would have bought those houses has dried up a bit because of Brexit. If you go down the other end of the scale, more towards the family homes and where the rest of us live, then that is actually becoming more of a seller's market, because estate agents, especially around London, are finding it hard to get stock on their books. So they're finding it hard to get houses on their books to sell. So when they do come on, they're being snapped up. And again, that is something that is possibly unique to the area outside of London, because as house prices have risen in central London or in the suburbs of London, Greater London, people move out to places like Kent, and so helps this kind of mini market, as it were, this trend of people moving out to get more for their money occur. So it's one of those things, there's no direct answer to that question where house prices will go, but it's going to be a bit of a mixed bag. The trend for mortgages was quite an interesting question.
Yeah.
So there's been a number of longer term mortgages out there. So you may have seen 10-year fixed mortgages, but there have been 40-year term mortgages out there in the market, and they're increasing in their number. Now, the reason for that is partly because it makes it more affordable for people to borrow. And with people not being able to raise a bigger deposit, especially first-time buyers, having a longer-term loan makes the mortgage more affordable, as in terms of their initial payment. But of course, over the long term, they'll pay more interest. So that trend is likely to continue, and that was the view of everybody on the panel, to be honest. And if you look across to Japan, where you have an economy that is perhaps not dissimilar to ours, where their economy has been in sort of stagnant for 2 decades. Ours hasn't, but we're in a world where inflation is falling, and we have got an aging population, so there are similarities. And I think we're going to have movements to longer and longer term mortgages, because in Japan they have 100-year mortgages, and they have mortgages which and property which you inherit in the pass down the generation. So I think we're going to start to move towards some of those models where we start seeing things like mortgages and debt inherited down through generations. But on another point, I think we're going to see much or many more products that start to link generations anyway. So you'll get people who have grandparents who have amassed wealth. Don't forget, as I said on previous podcasts, a lot of the wealth that's been generated in the past decade has been partly because of monetary policy like QE, so when they printed money, because anyone who had assets, they benefited, because when you print lots of money into an economy, what happens? It drives up prices of all sorts of things, from houses to stock markets. So if you own assets, that's the wealthy, or people who've got pensions or property already, which happens to be a lot of baby boomers, then they have got a lot of wealth and growth in wealth, whereas people who are younger, millennials, weren't around at that point and having those assets, they are therefore left behind. And I think what you'll start to see is products that enable the benefit of having wealth being allowed to be used by younger generations, obviously with the permission of older people and the people who have the money to be able to get on the housing ladder. Now, we've seen products that exist out there where the grandparent, or say the parent, would be able to put money aside into a savings account with a particular bank, and that bank would also then take account of that money. It's still in the parent's name and they've still got the benefit of it, but it's locked away for a few years. The children can then borrow money at a lower rate. So from the bank's perspective, if you think about it, they've got some deposit, some money on their books, and they'll lend to a young person, so the child of that parent, and they'll give them, rather than a 95% mortgage, it equates to something that's a much lower loan to value, so they'll get a better rate. But all the time, of course, that money is at risk for that parent. But overall, after the number of years, they'll get the money back. They'll have been paid interest on it, and after a few years, that child will be able to remortgage anyway and hopefully keep a low rate on their mortgage. So there's ideas like that have come about, and I think we're going to get a lot more of that. So the other panelists seem to agree as well that we're going to have much more where we're going to get wealth from the older generation being used, the benefit of it, even if they don't pass it on to the younger generation. And in my view, I think that will mean pensions will be accessible in some way, not like pension freedoms, because pension freedoms, I think, was partly a result of enabling the grandparents and parents to raid their pensions to give deposits to children to be able to support the housing market. Because obviously when they tightened lending criteria, that sort of stifled the market slightly. So I do believe pension freedoms was part of the reason for it, was to keep the housing market alive. But I think there'll be some more direct links between people's pensions and their younger generation's house, if they want to be, rather than actually raiding it, some sort of benefit as well. So I think there's a lot of interesting stuff. If you want to look across and find out what's going to happen in the future, I always say go and look at America. And even though one of the panelists disagreed with me, I'm afraid the fact is, personal finance, nearly everything comes from America. There are trends from other places, but the fact remains that if you look at anything from robo-advice down to even what's going on in the property market, a lot of it, a trend start in America and people either think, wow, that's a good idea, or those companies come over to the UK. And some of the exciting stuff that's happening in America even relates to the home buying journey. So I joked about a scenario my wife and I are sending each other, or she sends me, house price details about houses that we can't afford, about houses she'd like to live in. And this is all part of the idea that at some point we might need to move, for the same reason I mentioned earlier, for our children to go to different schools. The problem is there's a massive journey before you even get to the point where you will realistically go and look at a house. A, working out what you can afford. B, getting your finances in order. Then once you've gone and worked out what you can afford, then you've got to go and find those properties in what areas do they exist, and etc. In the future, that will change because of open banking. Now, I firmly believe with open banking, and I've seen companies that are making this possible in the UK in terms of the technology behind the scenes, but in America, they're doing some exciting stuff with Alexa. I think open banking will mean that when you plug into the likes of Starling and all those companies, where they can look at your spending in the future, these companies will be able to tell you ways to improve your finances to be able to increase your chance of getting a mortgage. And rather than you having to go to a mortgage broker or apply for a mortgage and fail yourself to try and work out how much you could borrow, you'd be told already. There'd be something that pop up on your phone that will go, do you know what, Andy, you could actually borrow this amount now, possibly. And then if you want to go through with it, then you can start the process of seeing if you could actually borrow that from the lender, and then they could check you and credit check you, etc. But at the same time, they could be looking at where you live and saying, there's properties like these where you live now that I reckon you could live there, you get more for your money, and start suggesting them. So put it this way, I live in southeast London, and I think I'd go and use the local shops. If I went to move out into Kent or somewhere like that further out, I might think, do you know what, I go to the shops all the time, I like walking there. But my bank could tell me possibly the fact that I go to other places more and shop, maybe out of town shopping centres, that therefore are still accessible from those places. What I perceive my life to be is actually very different if you look at my bank statement, and they will therefore be able to tell you that this is a good place to live for you because of the things you like to do. And so what you could get is your phone almost telling you that this is a possible dream for you that is reality if you want to start pushing these buttons. And I think that's the future. And in America, they've already got to the point where you can say to Alexa, how much more money could you borrow on a mortgage, or start asking questions about a mortgage, or even find out about details about houses in areas that you like. That is going to come to the UK at some point. So that's quite exciting. I think the whole thing will definitely change.
No, it's very interesting stuff. And another thing that was sort of highlighted on the evening and was spoken about quite a lot is about fixing, and whether it's the right time to fix, when you should fix, how long. What's your views on that?
The thing is, rates are so low that if you are inclined to fix, then it probably is. Well, you always say it's never been a better time to fix your mortgage, but then you find out rates keep dropping. And especially as the Bank of England are thinking, or it's been rumoured that they might cut rates in the future because of Brexit, if we have a hard Brexit, we just don't know. The point is, this era where we are now is a fantastic time to get a long, low rate on your mortgage. And I think there'll be people in the future who will look back at this period and say, I wish I'd fixed. The best thing to do is go and get advice and go and find out what mortgages are there available to you out there. There are, as they were talking about at the panel event, there's like 20,000 mortgages in the market. Find out which ones you're eligible for is another point you need to do. So go and seek advice. A mortgage is the one time I would always go and seek advice from a mortgage broker, because of that affordability and the criteria whether you'll be accepted. And so, yes, it's a great time to think about fixing your mortgage, but you need to go and have a look at your current deal, whether you're going to have to pay any exit fees. And also, don't forget, the longer you tend to fix for, there may be increased penalties if you have to have a change in the circumstances in the future.
Find out how fit your finances are for free with Damien's Money MOT. With no registration required and no need to access policies or paperwork, you'll receive your own personal grade, together with a breakdown of where you should focus your attention, all in the time that it takes to boil the kettle. Crucially, you'll get to see how you measure up compared to everyone else, and even get your own tailored plan on how to improve your score. Simply go to mot-money.co.uk mot.moneytothemasses.com. So sit back, relax, take Damien's free money MOT, go to mot.moneytothemasses.com to get started, and reward yourself with that cup of tea afterwards. So one of the best things about doing events and getting out and about is being able to meet up with listeners. And what was really good about Wednesday night is there were quite a few listeners there that came over and said hello, shook hands and said, oh, when you did this piece, it was really funny, or I really enjoyed. And it's just nice to get not only that feedback, it's not a sort of backslappy thing, but it's nice to understand what people want, and it gives us ideas for the future, doesn't it? And one of the guys there was Neil that we was chatting to, and actually bought us some drinks as well.
Yeah, I mean, I had a great time meeting so many of you, and I'm so glad you came up, because I was badgering you to say come up. And I know when people come up, there's always the tip of the iceberg. There's always other people who wish they did or had the sort of bravery. But it's great when you do, because then we always have fun conversations. We find out about things you want to talk about, us to talk about, things you want us to write about, and also we get an insight into what it is that's worrying people out there. So it was great to meet you all. And as Andy said, we got talking, and Neil in particular. And now Neil had a good story. So if you check out our Instagram, regularly we do bits and pieces on Instagram, and one of them is about Neil in particular. And Neil he was a really nice guy. He told us about the fact that he was very money savvy, and he said he did the money MOT, and he made me laugh because he said he got a B, and he was like, "Why did I get a B?" And he was gutted about it.
He's gutted.
And he then was obsessed with trying to get an A. And as part of that, he went through, did various bits and pieces, and he did eventually get his A, and he was well chuffed, and he was really making me laugh about it. But that was the whole point of trying to get people who are good with money still to be that little bit better by doing things they hadn't thought about. And on that, Neil said about he then went through the money MOT, and one part of it, I got him to check his home insurance. And as a result, he saved £220 a year. And he was blown away by that. And of course, what then that led on to, he wanted to take us all out for a beer down the pub, which we did. So look at Instagram, you'll see us with Neil down the pub, which was brilliant. So anyway, Neil then, because I wanted everybody to email me who met me that night. And if you haven't emailed me yet or got in touch, then please do, because I just like to try and remember people's names if I meet them again. And Neil got in touch and had a quick question about investing and selling investments. And he said, I'll just read it out. He said, I'm rebalancing my stocks and shares ISA ready for the new tax year. I was wondering if I was going about it the right way. I sold off the profit from my funds that had done well to buy more funds to get me closer to my asset allocation. However, I wondered if I could have just bought more of the funds I wanted and leaving my profit where it was. This way I get close to my asset allocation but only have to pay buy costs rather than both buy and sell costs. Right, I'm going to make sense of that, even though I read it out very badly. What Neil is actually trying to say there is he's got some funds, some have done well, he wanted to take some profit because he wanted to rejig his asset allocation. He was concerned that if he did so, would he be better off just using money he had to buy some of the stuff he really wanted rather than selling and then buying? Because a switch is always a sell and a buy. It always generally is. There's hardly anybody I've ever come across platforms that ever say it's just one thing. Now, Neil is right if they are investment trusts and ETFs. Most platforms now don't charge you for general fund switches. So if you're in a normal unit trust, then people like Hargreaves or Fidelity, they're free. So it wouldn't have made any difference to him if he'd minimised the number of transactions that he made, because there wouldn't have been any cost. So you have to check with your individual platform that you're using whether on unit trusts they will charge you for those transactions, and whether they make a fund switch, and did they actually say a fund switch is two transactions, i.e. a sell and then a buy. If it was ETFs, then of course that makes sense to try and minimise the number of transactions you make. The one thing to bear in mind, of course, there's another side to this. If it's a unit trust, they often are out of the market for a period of time. So if you make a fund switch, what happens, because they're priced once a day, is you'll sell a fund, you'll normally be out of the market for at least one day, and then you'll buy the next one at the end of that closing day. And depending on where the fund is or what assets they invest in, it can be longer than a day you're out of the market. So you can decide that, do you know what, if I really want to buy now, rather than sell and buy, if you had the cash already that you were going to invest, you could just have a buy and you'd be in at the end of that day, if that makes sense. So there are ways you could try and minimise the amount of time you're out of the market if you're using unit trust, if you have cash that you're looking to invest. One thing I want to point out on Neil's question, I just thought of something else, the answer to his question. There has been cases in the past where I've been thinking of doing fund switches, where I've had cash and I wanted to move from one fund into another. So if you imagine there's two funds, imagine there's one fund you've got, you want to go from fund A to fund B, but you've also got some cash within your ISA. if you go straight from A to B, there's going to be that delay in the transaction. You're going to be out in the market. Theoretically, you could sell A and at the very same time buy B with the cash you've already got. And so the transaction would happen almost identically on the same day. Does that make sense?
Yeah.
So you could theoretically do that. It does mean it's slightly hard to tie up the exact amounts, because don't forget that when you put a request to sell a fund, usually on a unit trust, you won't know the exact amount you'll get until the end of the day that you've already placed the trade. It's just the way the transactions work. So you won't be able to match up exactly the right amount that you buy or to take from your cash amount if you're trying to do it on the same day. But it's something to bear in mind if you're trying to minimise the amount of time you are out of the market. The one thing I didn't quite get about the question is, obviously, Neil's allocation, he still have all those funds. So if there was a fund that he thought he was overexposed to, he would still have that fund if he didn't sell the profit. But presumably he would think, I'm guessing he's thinking if he buys the funds he wants, then as overall it kind of brings it down. But as this all occurs inside an ISA, then there's no real tax consequences of it. So yeah, it's a good question from Neil. But if it's a unit trust, then you don't have to worry so much about the transaction cost if your platform doesn't charge you. But you do need to be mindful of the time out of the market. Of course, with ETFs and investment trusts, they usually trade straight away.
Good stuff. So that moves us on to the last piece, and we're going to cover train travel and how potentially you can make some savings. David, did you ever have a job where you were traveling? I imagine you did. You had a season ticket back in the day.
Well, when I used to travel, though, I didn't actually buy a season ticket. I never bought an annual one, but I used to buy monthly. And do you know what the problem is? You just get used to it.
Why was that? Did you have a problem with commitment, or what was what's the reason?
I'd like to say I always thought I was going to do money to the masses.
Yeah.
And therefore I didn't know when that was going to happen.
Got that flexibility.
No, the truth is I just didn't have the money to pay out for a season ticket for a year. And also, despite the fact it made monetary sense. But I think what happens is you always think trains are pretty poor in this country and you just put up with it.
But what Lauren in the office has done and really opened our eyes up to is that you can make some significant money back from the train services when they're particularly poor at what they do. It's called delay repay. Have you heard of delay repay?
No, I know the concept and I've heard about doing it, but it's one of those things I've never had to do. I've written about it on the site, but the rules seem to change, so fill me in.
So it's a nationwide scheme, and you would think because of that there'll be sort of rules in place, but there isn't. Basically, because the national rail's been chopped up into so many different pieces, everyone seems to have their own version of it and their own understanding of the rules.
So you mean that every franchise is different? There's no one unifying set of rules, depending on who you travel to work with. If you're unlucky to go with Southern, then you've got another set of rules.
Yeah, exactly right. But the rules are fairly structured, but you get some certain benefits by going through various people. So what is it? Basically, if your journey is delayed, generally, if your journey is delayed by 30 minutes or more, you are able to claim back some compensation for that journey. Now, depending on whether you have done a single journey, a return journey, or whether you've actually got some sort of season ticket, we talked about monthly or annual, you're entitled to certain percentages of that journey back. So the rough rule is if it's a single journey and you've been delayed for more than 30 minutes, you can go online and claim up to 50% of that journey back. If it's a return journey, you can claim 25% back. And if you're a season ticket holder, again, you can claim up to 50%. But crucially, and this is where they sort of get you, if you've got a season ticket, there's a rough bit of maths that they do to work out what that proportion of the journey is. Because, of course, you're making a saving already by being a season ticket holder. So you'll need to go online and work out what that actually equates to in terms of pounds and pence to you. Now, what's really good is if it's, I say really good, you don't really want to be delayed. Really, what you want to happen is you don't want your trains to be delayed at all. But the good thing is, if you are significantly delayed, and that means if your journey is delayed by between an hour or 2 hours, you can actually claim up to 100% of your money back. So you get your full money back. Again, different rules for season tickets and returns. Check online. This is interesting. If your train's been delayed for 2 hours or more, depending on what ticket type you've got and who you travel with, you can actually claim 200% of your travel back. So actually, you start to make money in that situation. So that's interesting.
That is. That surprises me.
There is actually something called enhanced compensation for some season ticket holders. So if you're a regular traveller and you are significantly impacted by some really poor punctuality in a given month, then you can actually apply for something completely separate. It's not called delay repay. You have to fill in another form, unfortunately, but you can get enhanced compensation. And normally that's in the form of a couple of free tickets that they'll send out to you in the post as a way of apologising. So what I would advise to people is, depending on who you travel with, get online. You can do all of these things and note down the journeys. If you've been delayed, make sure you write it down, because the problem is you forget about it and you've only got 28 days to make this claim. Once 28 days has gone, you can no longer claim.
Oh, I didn't realize. See, that's a timely reminder. So you're going to bung in the links at the bottom of this show in the show notes, are you?
We're going to bung in the links at the bottom of the show notes, and something to Google right now, and it gives you all the information there, is if you put into Google passengers' right to refunds and compensation, and it doesn't matter who you travel with, that's something run by National Rail, and it will give you all the details.
So the good news is that if you've been listening to this entire podcast while waiting for a train that hasn't turned up, not only have you been entertained, but you're now due some money.
That's it.
Yeah.
Do you know what? And it can add up as well. Oh, one thing I can add on that, you can choose to bank your credits. So you can actually total it all up and they'll save it all up for you, and then you can use that to pay off a significant portion of your next season ticket.
That's a good idea. It's a good idea. They'd rather keep the money themselves. Keep the interest.
They keep the interest.
Yeah. That is it for this week, Andy. I'm done.
Good stuff. So if you'd like to get in touch with Damien or myself, you can do. So it's damien@moneytothemasses.com. If you've got something you want to talk to me about, then send me an email, andy@moneytothemasses.com. Check out our Instagram. Just search for Money to the Masses on Instagram. We're on Facebook as well. And please make sure you review us, because it really helps us to go up the iTunes charts. We're done. Until next week.
Until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.